In this video, we're going to be looking at recent stock purchases made by members of Congress. Why? Because they miraculously seem to be able to beat the market when so few can. Let's start with Democrat Congressman Jonathan Jackson, who bought McKesson Corporation in March. McKesson plays a crucial role in the healthcare supply chain, distributing approximately one-third of all pharmaceutical products used in North America. The company has been an early adopter of technologies such as barcode scanning for distribution, pharmacy robotics, and RFID tags to enhance operational efficiency. This stock is a borderline buy, and here's why. First is oncology boom, could be a cash cow. McKesson's oncology platform is growing fast, with moves like acquiring a stake in Florida Cancer Specialists and expanding its U.S. oncology network. Big revenue drivers in a healthcare sector that's only getting hotter. But the stock's already priced pretty high, so you're betting on that growth outpacing expectations. Second is earnings glow up keeps investors hooked. The company's been crushing it with a 19 to 20% adjusted earnings per share growth forecast for fiscal 2025, and they just raised guidance again after a solid third quarter. Still, those tight margins, hovering under 2%, mean any slip-up could hit profits hard, making it a bit of a tightrope walk. Third is dividend drip ain't enough to sip. McKesson's bumped its dividend for 8 straight years, now at 71 cents per share, but with a yield of just 0.4%, it's not exactly raining cash for income investors. Compared to the S&P 500's 1.7% average, this one's more of a slow burn than a juicy payout. Fourth is big dog status comes with big competition. As one of the top 3 U.S. pharmaceutical wholesalers, McKesson's got scale and leverage that's tough to beat, but rivals like Cencora and Cardinal Health are always nipping at its heels. Plus, pricing pressure in generics could squeeze those thin margins even tighter. Fifth is stock price party might be overdone. MCK's up 400% in the last 5 years, outpacing the S&P 500, and analysts are pegging a 657 average price target, down from current price levels. That suggests the rally might be losing steam unless something big shakes up the story. I'm going to reveal the rest of the stock's 20 seconds, but before I do that, I want to remind you to click the link in the description to check out AlphaPicks. I reviewed over 100 stock picking services, and AlphaPicks performs the best and actually beats the market easily. If you click the link in the description, you get $50 off AlphaPicks. So go ahead and click that link and take advantage of this amazing deal. Tony Wide, Republican from Wisconsin, just bought The Trade Desk. The Trade Desk is an American technology company specializing in real-time programmatic marketing automation. TT operates the world's largest independent demand-side platform, enabling advertisers and agencies to purchase digital ad inventory across various channels including display, video, audio, and connected TV. I think Trade Desk is a strong buy after dropping 50% this year, and here's why. First is Bargain Bin Beauty. TTD's 50% discount is too good to pass up. After dropping over 50% from its December 2024 peak, the Trade Desk is trading at a much more reasonable valuation, around 9 times this year's revenue, making it a steal for a company with its growth potential. Second is Growth Engine still roaring, 18% revenue gains ahead. Despite a slowdown scare, analysts are projecting 18% revenue growth for 2025, showing that the Trade Desk's core business remains a leader in the massive digital advertising space. Third is AdTech King, dominating the programmatic revolution. The Trade Desk owns the world's largest independent demand-side platform, perfectly positioned to ride the wave of programmatic advertising and the shift to connected TV, where it's already a go-to for big streaming players. Fourth is Profit Powerhouse. Cash flow keeps the bulls happy. With $641 million in free cash flow in 2024 and a history of profitability since 2017, this company isn't just growing, it's stacking cash, giving it flexibility to innovate and expand. Fifth is long-term vision, just scratching the surface of a trillion-dollar market. The Trade Desk has captured less than 2% of the $830 billion global ad market, and with digital ad spending expected to soar to $1.2 trillion by 2030, the runway for growth is absolutely massive. Republican House member Marjorie Taylor Greene bought Caterpillar a few days ago. Caterpillar, founded in 1925, is a leading American manufacturer of construction and mining equipment, off-highway diesel and natural gas engines, industrial gas turbines, and diesel-electric locomotives. Caterpillar's recent stock crash makes the stock interesting, but I still don't think it's a buy currently, and here's why. First is macro headwinds are bulldozing profits. Caterpillar's facing a tough macroeconomic environment with slowing global growth and potential tariff pressures, which could slam the brakes on its earnings, especially since it's so tied to construction and mining cycles. Second is sales guidance hits a speed bump. Management recently forecasted a slight decline in full-year sales for 2025, signaling weaker demand ahead, and that's not the kind of momentum you want to see in a stock you're betting on. Third is earnings per share taking a dip. Analysts are projecting a 6.5% drop in EPS for 2025 to $20.47, down from current levels, suggesting that even with its cash flow strength, profitability might be stalling out. Fourth is valuations looking a bit too heavy. With a price-to-earnings ratio hovering around 15, CAT's not exactly screaming undervalued compared to its historical averages, or peers like Deere, especially given the sluggish outlook. Fifth is cyclical risks are revving up. Caterpillar's business is super cyclical, and with residential construction cooling and commodity prices volatile, those big yellow machines might not be moving as fast as investors hope. Next, we have Gil Cisneros, a Democrat from California, and he bought ASML a couple weeks ago. ASML Holding, established in 1984 and headquartered in Veldhoven, Netherlands, is a leading supplier of photolithography equipment essential for semiconductor manufacturing. The company specializes in developing and producing advanced machines, including extreme ultraviolet lithography systems, crucial for fabricating cutting-edge microchips. I think ASML is a borderline buy, and here's why. First is monopoly power. The EUV king still reigns supreme. ASML's unrivaled control over extreme ultraviolet lithography machines makes it the backbone of advanced chip production for giants like TSMC and Samsung. No one else can touch their tech, giving them insane pricing power and a moat that's tough to crack, though competition looms on the horizon. Second is growth forecast. 2025 rebound looks juicy but not guaranteed. Management's projecting a solid revenue bump to 30 to 35 billion euros in 2025, fueled by AI chip demand and new fabs, which is tempting. But after a shaky 2024 and a slower than expected recovery, there's some risk it might not hit the high end, keeping me cautious. Third is valuation vibes. Premium price, reasonable potential. At around 29 times this year's earnings, ASML isn't cheap, but with analysts eyeing 23% EPS growth in 2025, it's not outrageous for a market leader. Still, if growth stumbles, that premium could shrink fast, making it a tight call. Fourth is geopolitical jitters. China restrictions stir the pot. China's 20% of ASML's 2025 revenue is under pressure from tightening U.S. export curbs, which could dent sales. They've got a backlog to cushion the blow, but this wildcard keeps it from being a slam dunk buy. Fifth is cyclical comeback. Semiconductor swings are back in play. The chip industry is turning upward with AI and new fabs driving equipment spending, and ASML's poised to ride that wave. Problem is, cycles can flip quick. 2024's flat growth reminds us it's not always smooth sailing. Democrat Kelly Morrison bought Target last month. As of 2025, Target operates nearly 2,000 stores across all 50 U.S. states. The company offers a wide range of products, including clothing, electronics, groceries, and home goods. Target has also emphasized its owned brands and exclusive collaborations to differentiate itself in the competitive retail landscape. I personally like shopping at Target a lot, but after 4 years of poor performance, this is not a stock I would buy, and here's why. First is discretionary spending blues hit Target hard. Target's been taking a hit because consumers are tightening their belts on non-essential items like home goods and electronics, which are a big chunk of their sales, and that's dragging down growth. Second is Walmart's winning while Target's wincing. Compared to rival Walmart, which is soaring with a 45% stock climb in the last 6 months, Target's down 3%. It's losing the retail showdown as budget-conscious shoppers flock elsewhere. Third is tariff terrors loom on the horizon. With potential new tariffs threatening to hike costs, Target's already slim margins could get squeezed even more, making it a risky bet in an uncertain economic climate. Fourth is earnings slip-up signals trouble ahead. Target's latest earnings showed a drop in adjusted earnings per share from $2.98 to $2.41, and weaker guidance has analysts spooked. It's not inspiring confidence for a quick rebound. Fifth is inventory overload weighs down the bullseye. Despite claims of fresh stock, Target's piled up with inventory it's struggling to move, and in a price-sensitive market, that could mean more markdowns and less profit. Democrat Lloyd Doggett just bought Home Depot last week. The Home Depot is the world's largest home improvement retailer. Headquartered in unincorporated Cobb County, Georgia, the company operates over 2,300 stores across the United States, Canada, and Mexico. I feel the same way about Home Depot as I do about Target. I like the store, but I don't like the stock, and here's why. First is housing market blues are hitting Home Depot hard. The housing market is still shaky with high interest rates and sluggish home sales, which means fewer people are splurging on big home improvement projects that drive Home Depot's revenue. Second is big ticket items are collecting dust on the shelves. Thanks to those pesky high interest rates, customers are holding off on financing pricey purchases like appliances and flooring, putting a dent in Home Depot's sales growth. Third is lumber prices are climbing, but profits aren't. Lumber costs are on the rise again, squeezing Home Depot's margins since they can't always pass those higher costs onto budget conscious shoppers. Fourth is the valuation's too rich for a slow growth story. Home Depot's stock is trading at a premium with a price to earnings ratio around 27, which feels steep for a company facing flat or declining sales in this economic climate. Fifth is competition's heating up and stealing the spotlight. Rivals like Lowe's and even smaller specialty retailers are stepping up their game, offering more brand variety and chipping away at Home Depot's market dominance. And make sure to click the link in the description to check out AlphaPix and get $50 off this amazing stock picking service.